Welcome to the deep dive. We're here to cut through the noise and give you the insights you need. 2020.
Yeah.
We all heard it called unlike any other.
Oh, yeah, that phrase got thrown around a lot.
It really did. But cliches aside, it was a serious test for companies. Today, we're going deep on one company, Markel, and how they navigated, well, all of that.
That's a really interesting one.
Yeah, Markel, they're kind of a unique mix, aren't they? A part specialty insurance, part investment firm, part owner of all sorts of businesses, manufacturing, medical stuff.
A diverse portfolio, definitely.
But what holds it together, and this is what we're focusing on, is what they call the Markel style. It's their explicit creed.
Right, not just marketing fluff.
Exactly.
Yeah.
You talk about hard work, really going for excellence, keeping a sense of humor, and crucially, honesty and fairness. Our mission today is to see how those values plus their win-win-win idea.
Win-win-win
Yeah.
for employees, customers, and shareholders.
Right. How that whole philosophy acted like their compass when things get, well, chaotic globally.
It's a perfect real-world test case, isn't it? 2020 really put corporate design under the microscope.
Absolutely.
What happens when a company, even one that thinks it's built for resilience, faces something it just, did not see coming?
Yeah.
So this deep dive, we'll look at their strategies, the hurdles they face, their outlook, and maybe find some lessons for everyone listening.
Okay, so this Markel style and win-win-win. It sounds good, right? But when a crisis hits, don't those ideals sometimes fade?
Yeah.
Survival mode kicks in.
That's the million-dollar question, isn't it?
How do you actually use honesty and fairness when everything's up in the air?
Well, for Markel, they argue this commitment is their survival strategy. They call it the ultimate in sustainability.
Sustainability. Interesting word choice.
Yeah, because the belief is that serving others works forever. It creates this durable flywheel.
A flywheel. Explain that a bit.
Think about it. If you're genuinely focused on service, you tend to attract good people, right? People want to work there.
Makes sense.
You attract the capital you need for growth. And you attract other businesses that kind of fit your values. So this values thing isn't just nice to have, it's an anchor.
So it creates loyalty, like a stronger ecosystem.
Exactly. Employees, customers, partners, they're more likely to stick with you when things get tough compared to a purely transactional relationship. It's almost like a shock absorber built in.
Okay, I see. And that ties into the win-win-win. So the employee win is a good career, security.
Yeah, fulfilling work, continuous learning, providing for their family, feeling secure even when the outside world feels, crazy.
And the customer win.
That's getting protection against the unexpected, like insurance, or getting quality products and services. Could be anything from food equipment to medical devices to, even green plants.
Right, their ventures businesses.
And then the shareholder win is, naturally, earning good returns on their capital, which lets Markel keep doing everything else.
So it's this idea of building one of the world's great companies by doing things for people, not just extracting value.
Pretty much. Where employees win, customers win, and shareholders win too. A virtuous cycle, like you said.
Okay, let's picture Markel at the start of 2020. Things were looking good, right?
Oh, yeah. They said they were brimming with optimism.
2019 was a banner year. Insurance side had a 94% combined ratio, which, for listeners, that's really healthy, means they made money on underwriting.
Very healthy. And investments. A 30% return on equity. Stellar.
Plus, their ventures businesses hit a record $264 million in EBITDA. That's a key profit measure.
They were ready to bring it all home, as they put it. And well.
The pandemic ensued.
Yeah.
Their words.
Yeah. And they're very upfront. We did not see that coming.
That candor is interesting.
It is. But they also stressed they were designed for resilience. And that design, they say, let them make forward progress despite the pandemic.
Which makes you think, right, how do you build that adaptability when you just can't predict what's next?
Exactly. It's less about prediction, more about preparation for the unpredictable. A lesson for all of us, really.
Absolutely. They called 2020 a punishingly brutal exam. That's strong language.
It is. And despite that, they still pulled in, $1.2 billion in comprehensive income for the year?
Which is significant. But they were still honest about falling short, weren't they?
Yeah, they felt the shareholder returns didn't quite match the economic value created, so they called it 2.5 out of 3 wins.
2.5 wins.
And they said that was not satisfactory. That level of self-critique, even amid a global crisis, tells you something about their culture.
It really does. Okay,
Wow.
So how did they manage even those 2.5 wins? You mentioned their structure. The three engines.
Right. Insurance, investments, and Markel Ventures. The idea is they provide positive thrust and diversification. If one engine sputters, the others keep things moving.
And in 2020, all three actually contributed. That's
Yeah,
pretty remarkable.
it really is. Let's start with engine #1, insurance. They faced truly unprecedented challenges.
Like the event cancellation example they gave, that was wild.
Absolutely vivid. They insured all sorts of events, right? Tennis in the UK, the Olympics, music festivals, weddings, parades, you name it.
Thinking they were diversified.
Exactly. Assuming, a wedding in Ohio isn't correlated with a concert in Tennessee, but with the pandemic,
Everything correlated.
all of those risks correlated to each other. Boom! Every single event got canceled. Massive, unforeseen losses.
Wow. Like trying to plan anything that year, basically. Just smoke.
Pretty much. Their COVID-related losses, including business interruption stuff, hit $325 million in Q1 alone, plus another $33 million later.
Ouch.
But what's key is they tried to recognize those losses quickly amidst all the uncertainty. They didn't just, hope it would go away.
And despite that, plus hurricanes,
More hurricanes than names.
wildfires, and a derecho. What even is a derecho?
It's like a massive, long-lasting windstorm. Nasty stuff.
Okay, so despite all that, they still managed an underwriting profit.
A modest one, yeah.
Yeah.
Combined ratio of 98%. Not their target, but considering everything. Pretty resilient.
So, okay, pandemic, storms, things they couldn't control. What do they do? What was in their control?
Good question. They highlighted three main things. First, they cut back significantly on their exposure to natural catastrophe.
Why?
They just decided the returns weren't justifying the risk anymore, needed better pricing.
Makes sense. What else?
Second, efficiency. Really pushed on that, investing in tech, streamlining things, got their expense ratio down from 37.7% in 2018 to 36.0% in 2020.
Okay, cutting costs, getting leaner. And third,
They set a really ambitious goal, 10-5-1.
10-5-1. Sounds like a code.
Sort of. It means $10 billion in annual insurance premiums within 5 years.
Okay, big growth target.
While generating $1 billion in annual underwriting profit.
Ah, the one. So grow big, but grow profitably.
Precisely. The 5 years injects urgency. In today's world, you have to move fast, right? Technology changes everything so quickly.
Sure.
And the billion in profit reinforces that growth for growth's sake doesn't work. It just eats up capital if it's not profitable. It has to be sustainable growth.
That's a clear message. Okay, let's switch gears. Engine, #2 investments. 2020 markets were a roller coaster.
Epic volatility and uncertainty, as they put it. Understatement, maybe.
Seriously.
Yeah.
Yet they reported a 9.4% total return, 15.2% on equities, 5.7% on fixed income. How?
Well, they talk about their North Star guiding them. For fixed income, it's super clear. 2 priorities.
Okay.
1, absolutely paramount. Make sure you can pay claims. That's the foremost promise. No messing around there.
Got it. Safety first.
2, earn some interest income. But with rates going lower and lower, even negative sometimes.
Yeah, tough environment.
They stayed conservative. They chose capital integrity and stormworthiness over chasing tiny bits of extra yield by taking on more risk. They felt that was just unwise.
Prudent. Okay, what about equities? They have a specific approach there too, right?
Yep, a 4-part discipline. 1, find businesses with good returns on capital without tons of debt.
Sensible.
2, management teams need talent and integrity. Big emphasis on integrity.
The Markel style again.
Exactly. 3, look for companies that can reinvest their profits wisely with capital discipline. And 4, the classic, only buy at fair prices.
Standard value investing principles mostly. But you mentioned a tactical yet difficult decision early in 2020.
Ah, yes. They actually reduced their equity holdings by about 20% early in the year.
Wait, so they sold near the lows before the market rebounded later. That sounds counterintuitive for long-term investors.
It does on the surface. And
Right.
they acknowledged it was difficult and meant selling lower than year-end prices.
Well, why do it?
They felt the whole economic landscape had fundamentally changed. They reevaluated everything. The decision, they said, was about protecting the overall company.
Protecting the mothership, basically.
Right, maximizing their strength to keep writing insurance policies, which they saw as potentially very well priced given the uncertainty. It was about prioritizing the best use of capital at that moment, even if it meant missing some later stock market upside. Protecting the core business.
That takes conviction. Okay, now for the real surprise. Engine #3, Markel Ventures. They're a collection of non-insurance businesses.
Yeah, this is where it gets really interesting.
You'd think these businesses, many being cyclical, would get hammered in 2020.
It would. But they had a spectacular year, set records. $2.8 billion in revenue, $367 million in EBITDA.
How on earth? What's the secret sauce there?
They called it amazing and gave huge credit to their managers, said they responded in spectacular fashion.
So what kind of challenges?
Everything. Keeping workers safe and healthy, dealing with totally broken supply chains, constantly adjusting costs, just immense uncertainty and pressure. Their leaders really stepped up.
Shows the quality of the businesses they buy, maybe? Or the leadership?
Probably both. And speaking of buying businesses, they made a significant acquisition right in the thick of it, April 2020. Lansing Building Products.
Buying a building products company in April 2020. Bold move.
It was, but strategically important. First, it gave a long-term home to a family business, third generation, that fit their values.
The Markel style fit again.
Right. And second, it added diversification. Building products might be on a different cycle than, say, insurance or medical services. Adds resiliency and dependability to the whole enterprise.
So let's connect the dots financially on ventures. How's that portfolio performed overall?
Pretty impressively, over 15 years, they'd put in about $2.7 billion total into these ventures businesses.
Okay.
Those businesses have either paid back in dividends or built up cash internally, totaling around $1.2 billion.
So net investment of $1.5 billion.
Exactly. And that $1.5 billion net investment generated $367 million in EBITDA just in 2020.
Wow, that's a strong return, especially in that year. Shows the long-term value creation, not just a quick flip.
Definitely. It's a core part of their value proposition.
All right, underlying all this, the insurance, the investments, the ventures, is how they manage their capital. They have a system for that too, right?
Yep. A 4-step triage, they call it. A priority list for where the money goes.
Okay, what's the order?
First priority, support the existing businesses. Give them the capital they need to thrive and grow organically.
Makes sense. Feed what you have.
Second, acquire new businesses like Lansing that fit the mold.
Strategic growth.
Third, if opportunities in the first two are covered, buy publicly traded stocks that meet their criteria.
The equity portfolio we discussed.
And fourth, last on the list, repurchase their own stock, but only if they think it's trading below its true value.
Okay, a clear hierarchy.
Yeah.
How did that play out in the chaos of 2020?
It was dynamic. Early in the year, they were doing all four. Funding existing ops, looking at deals, buying stocks, repurchasing shares.
Business as usual pre-pandemic?
Right. Then boom, pandemic hits. So they kept funding insurance growth, step 1. They did the Lansing deal, step 2.
Okay.
But they stopped buying more public stocks, step 3. And even sold some, as we discussed. They stopped share buybacks, step 4.
Slam the brakes on those.
And importantly, they proactively raised $600 million in preferred equity, basically adding a cushion to their balance sheet for maximum flexibility. Insurance against the unknown, you could say.
Smart move. Building a war chest.
Exactly. Then, later in the year, as things stabilized a bit, they cautiously started buying modest amounts of public stocks again.
So, constantly adjusting the taps based on conditions. Real-time capital allocation.
It really shows their flexibility and how they stick to that triage system, but adapt its application dynamically.
Okay, so looking back at 2020 and forward, they sound pretty optimistic, despite the brutal exam.
They do. They point to their resilience, the strength of that values-based system, their flexibility, and just an unending dedication to those three groups. Customers, employees, shareholders.
The win-win-win.
Yeah, they really believe win-win-win works, and it represents the ultimate in sustainability. They see it as a proven formula, not just aspirational talk, especially powerful when tested under fire.
So wrapping this up, Markel's journey through 2020 is quite the story. It shows that even if you can't predict the future, and who can, having clear values, building for resilience, and executing with discipline, well, it allows you not just to survive, but actually make progress.
It's a powerful case study in endurance, adaptability, all those things. Yeah.
And they keep coming back to that timeless formula from their 1986 Markel-style document.
What was that again?
We believe in hard work and a zealous pursuit of excellence while keeping a sense of humor. Our creed is honesty and fairness in all our dealings.
Simple but powerful.
And they truly believe those words are what will drive their results going forward, just like they did in the past. Sticking to the fundamentals.
So the final thought for you, listening. In this world that feels like it's constantly changing, often unpredictably, how do you find and lean on your own timeless formulas? your own core values, whether it's in your work, your organization, or just your life.
Yeah, what does real long-term sustainability mean beyond just the financial numbers?
And how do you cultivate that resilience so you're ready when the unexpected inevitably arrives? Something to chew on as we all navigate whatever comes next.